Hey everybody, I'm Logan Burchett, co-founder, chief operating officer over here at Forecastr, and I am here at Forecastr's HQ in Louisville, Kentucky, and I'm here to talk to you all about financial modeling, specifically as it relates to raising capital. So here at Forecastr, we do a lot of content around how to use a financial model to supercharge your business, how to use a financial model to really supercharge the fundraising process and make a financial model your secret weapon whenever it comes to fundraising. And we typically do this in a webinar format, but we wanted to produce some short video content that is hopefully very helpful whenever you're thinking through how to plan a fundraise, how to loop in a financial model to the conversations as it relates to a fundraise, and really just how to bring finance and fundraising together and create something that's really gonna supercharge the process and make it go just a lot more smoothly and really make you stand out whenever it comes to fundraising and really stand out with the crowd from all of the other companies that are pitching these investors for investment. Because we all know that to close a round, you need to be in the top 10%, the top 1%, and you can't get there just by doing the bare minimum. So what we're gonna be talking about today is just how to loop a financial model into the conversation, into your pitch deck and things like that. So I've got some questions that have already been teed up for me from the Techstars team, so I'm just gonna be using those as talking points and really sharing my thoughts and sharing the thoughts of Forecastr on how to go about this. The first question that I want to answer is how to leverage a financial model in your pitch deck, which it's an amazing question. It's a question that we get all of the time. So the trick to using a financial model whenever it comes to your pitch deck is to keep things high level and not go too deep in the weeds too quickly. Now, let me be clear whenever I talk about a pitch deck, what I'm talking about is the concise 8 to maybe 15 slide pitch deck that's used to create a narrative around your business whenever it comes to fundraising. It's meant to be a tight narrative, more of a visual narrative, not meant to be a deep dive into the specifics of your business. So a lot of people, if they're like maybe first-time founders and they've spent a lot of time on their financial projections and their financial model, they're tempted to put a lot of data into that short slide deck and then go really deep really quickly. Now, the problem with this is whenever you're fundraising, what you're really trying to do is build an emotional connection at the onset between the investor and you as the founder and your company. So if you're in an early meeting and you're talking about the mission of your company and the vision of your company and your team and your traction and things like that, these are all very emotional things. You want the investor to get excited. You want to get them to want to learn more and want to dig in deeper into your business. But then whenever you go to a financial slide and you go really deep into the unit economics of your company, then all of a sudden this emotional conversation turns into more of a transactional conversation. So now they're wanting to dig in and understand, okay, what's your LTV to CAC? And okay, let's try to understand what your margins look like. And it takes the emotion out of the conversation. So the trick that we like to advise companies with is try to get the emotional buy-in first, and then use the financial model, use the projection slide to get more face time with the investor, to build more familiarity and to build more trust. So the way that you do that is in a concise pitch deck, you have a slide that pertains to financial projections, but it's a fairly vague slide. So it's a slide that maybe has a revenue graph, or maybe it has some very big numbers as it pertains to like margins or like maybe projected year 5 net income or something like that. Just big wow factor type of slide, like basically a slide that's just got something that's going to pique the investor's interest is really what you're trying to do, but not go too deep into the weeds. The reason that you do this is because you want the investor to look at it and want to understand where those numbers came from, right? What you're baiting in this slide is the investor to say, where did you get those numbers? I want to understand this a little bit more. I want to understand where your head's at and dig into the logic behind this. That's exactly what you want to have happen, because whenever that happens, that's your cue to set up another meeting with the investor to go through and do a deep dive into the financials of your company and really dig into the nuances there. So you've segmented to get the emotional buy-in. That's step one. That's what you're doing during the initial pitch, and that's why the pitch deck is largely centered around drumming up emotions in the investor, and then use their curiosity to further the process by getting another meeting to talk about the economics of financials of your company. So that's our tip whenever it comes to leveraging a financial model in your pitch deck. The last thing that I'll say on it before I move on to the next question is I'm a big fan, and we at Forecastr are big fans of having a very tight pitch deck, maybe 10 slides or so, and an incredibly robust appendix. so that if an investor wants to do a deep dive and it's appropriate to do, you're prepared and you can flip to all of the logic that's powering your financial model and then some, right? So you can have an appendix that covers deep customer testimonials, you deep dive into traction, deep dive into finances, all of that stuff. So that's the other tip that I'll service here. The next question is how to present a financial model to investors. And this is a very important one. So now I've gotten the pitch deck and I've used my financial model to hopefully pique their curiosity and then further the process. Now we're in another meeting that's meant to do a deep dive into the finances, the business, and the financial models. So how do I run that meeting? The best way that I advise people on running that meeting is be prepared, make sure you know your financial model, you spent the time understanding your projections so that you can speak to it intelligently. That's very important. So you do that. Don't share the financial model with them before the meeting. That's our opinion, that's our stance here at Forecastr. The reason for that is if you share a financial model before the meeting, the investor's going to dig in, they're going to take a look at it. Now it's their job to say no to 95, 99% of the companies that they review. So if they're looking at your financial model, they're not going to be looking at why is this financial model so great? What makes this company amazing? They're going to be looking at what's wrong with this company, right? They're looking at it in like a more of a negative mind frame because that's their job. That's what they're trying to do. They're trying to weed out the weak companies and invest in the strong companies. If you send them a financial model without context and without being in the room, they're going to find issues and they're going to find things to challenge about that financial model. And you're in a powerless position at that point to defend your financial model. So then whenever you finally do meet with them, you're having to drag them, in theory, from a negative perspective about your business, about your financial model. You have to drag them over to a more positive perspective about your business and your financial model. It's much easier, instead of trying to drag somebody from here, to shape their opinions at the onset and try to get them the context that they deserve in the first place, so that hopefully whenever they first form an opinion about your financial model and your business, then it's in more of a positive light. So don't send them their model, use it as a leverage point to get the call and get in front of them and actually talk to them about the finances of your business. And then whenever you're doing that, you want to be in control, be confident, show that you know your stuff. Don't be overly married to the specific output of the financial model. So the first thing I like to do whenever I go through my financial model with investors is say, the first thing and the one thing that I do know about these projections that we're about to go through is that they are 100% wrong. There's a 0% chance that we hit everything dead on. So this is me and my team's best estimate, our best guess, kind of our strategic roadmap of what we think is realistic and what we are going to be shooting for. So we want to present that to you, but just know that it's going to be wrong. This is just what we're shooting for here. What I like to do in that meeting, this is just like a tip, is it's a similar thing to whenever you use the financial model to your pitch deck. You want to whet their appetite and get them excited and then take them through the details. So I do an approach that I call the zoom out, zoom in approach, where I start with an annual income statement and I show them how big the company is going to get and how profitable we're going to be 5 years out, 6 years out, however long I forecast. So I show what the revenue looks like, I show what the net income looks like, I show that it's this big, massive opportunity. That's how I start, and then I say, now I want to show you how we're going to get there. That's whenever I take them through the details, where I go through my customer acquisition forecast, my revenue forecast, my people forecast, all of the salaries of the folks that I'm going to be hiring, all of my expenses, things like that. And I always end on the equity section, the fundraising section. That's how I loop it back to the transaction at hand. That's where I want to discuss the fundraise and why they should invest in the company, and it brings everything home. So that's my tips on how to run that meeting. Third question that I want to talk about is how to set a forecast that's attractive but reasonable. So my biggest tip here is just understand what you're trying to do and who you're trying to pitch, because it all centers around really the outcome that you're trying to get for yourself as a founder and your employees and the investors, right? So I'll use two extreme examples just to give you a sense of how to set a forecast depending on what you're trying to do. So one end of the spectrum is the moonshot. That's the, we want to be $1 billion company. We're going to do significant rounds of financing in order to get there. So we're not going to turn a profit for a long time. We're going to grow very quickly. And our goal is to become a unicorn, $1 billion company, right? The forecast for that opportunity is going to look a lot different than a company that wants to maybe raise a round of funding, but use that funding to get to profitability and have a good, strong, solid business, but not necessarily that moonshot, not something that maybe is going to be $1 billion company. Maybe it's a company that does 10, 15, $20 million of revenue and is very profitable, and investors might want to invest in that business, but it's a different narrative. It's an entirely different method for going about building businesses. So that's step one, is understand, what do I want to do? Once you understand what you want to do, make sure that the investor is on board with what you want to do. So what you don't want to have happen is you want to build maybe a smaller, more sustainable, but highly profitable business, but your investor thinks they're getting into bed with a company that wants to become a unicorn that's going to be super high growth, tripling every single year, that type of thing. And then you are at odds with each other, and then you're going to have issues whenever they slowly realize that you all aren't on the same page. Get on the same page, make sure that you know what you're doing, and then your projections should tell the story of that outcome. So if I'm trying to do the moonshot, if I want to be $1 billion business, then I want to paint the path in a financial projections, in a set of financial projections that shows what that might look like. So the common kind of theme that we see there is known as the T3D2 model, where you triple, double after you hit $1 million of annual reoccurring revenue. The idea there is, if you do that, then you go from, if you triple 3 years and then double twice, you go from $1 million of annual revenue to roughly $100 million of annual revenue, which is where you're flirting if you're a SaaS company with $1 billion valuation at a 10x multiple. So that kind of shows the trajectory of a unicorn, and that's that high growth situation that's going to command a very high valuation. You want to show that high growth, you want to show very quick revenue growth, but you also want to show you getting to a point of revenue, to a point of profitability that would sustain a valuation that's going to be in line with what the investor's looking for. That's really what you want to do. And in terms of making sure that it's reasonable, just check with your benchmarks and beat it up against some other friendly investors or some mentors, or come to Forecastr and we'll be able to help you out with that as well. You want to make sure your net income's in line. You want to make sure that your revenue per FTE is in line. You don't want to be doing $100 million of revenue with 10 employees. You get the idea. Stuff like that, you just want to make sure that your unit economics, your margins, all of that stuff is roughly in line with maybe the top tier of a benchmark, right? So that's what you want to do, is figure out what they want and then paint that picture. If you want to do a more sustainable kind of growth path, it's the same deal. It's just going to be, you're going to be raising less in the financial model. You're going to be growing less. Instead of tripling every year, maybe you're doubling, or maybe less. Maybe it's 50% growth every year, and you're doing so with less resources, which makes sense, but you still want to paint that path of the outcome that you both want, right? That profitable kind of outcome for your business. But same metrics are going to be important. You still want to look at the amount of employees that you have, the revenue per employee, your unit economics, make sure they're not getting too out of whack, margins, things like that. So just my advice would be, get smart people in the room that know finance, that know the game, get them to look at your projections and get them to weigh in on it, and then they'll let you know what they think, if they're reasonable or unreasonable. The fourth question that I want to talk about is, what do investors want to know about your financial model? And really the answer is, it depends on the investor, right? And that's a blanket answer to, I think, a lot of these questions. But in general, what the investor is looking for are really a couple of things. First and foremost, they want to ensure that you're vetting your way of thinking, your approach to thinking, your approach to the market, and just getting an understanding of how you're thinking of tackling the space that you're in. So the way that I like to describe a financial model is, see where a pitch deck is a visual narrative of your business and a visual narrative of the vision of your company. A financial model, it tells the same story, but it's a mathematical representation of your vision. It's a mathematical representation of what you want to do. So they're both telling the same thing, they're just telling it in different ways. And because the financial model is a mathematical kind of simulation of your business and what you think is going to happen, then there's harder numbers to look at, and they can get a more tangible sense of the goals that you're aspiring to achieve. So that's the first thing that they're wanting to vet, is just your mindset and how you're thinking about tackling the space and how you're thinking about growing the company. So once they've gotten a sense of that, what they're really trying to understand is the scalability of what you're trying to build from a financial perspective. So they're going to want to understand, where are your metrics today, and what are they going to be in the future, and how much do things have to change in order for you to create a really massive or attractive or scalable business. So if today, let's say your churn rate is 10% monthly, right? It'd be very high. And you're saying, I want to become a unicorn, right? They want to understand, what does your churn rate need to look like going forward in order for you to achieve the outcome that you both want? And just getting a sense of, what do the unit economics of that business look like, and what do they look like today? What do they need to look like in order to get to the outcome that you both want? So if you have incredibly solid base of metrics, if your churn rate looks great, if your price looks great, if your customer acquisition looks great, all of that stuff, you can plug those into a financial model and you'll have a very strong narrative, because you can say, look, we don't really need to change at all. We just need to keep acquiring along this path that we're on right now. Our economics are already really solid, so all we need to, and our distribution channels are already working, so we just need to keep doubling down, and then it's just a time game of execution and time and focus, and then we'll get to the outcome that we both really want. That'd be a very strong narrative. If maybe you've got some challenge metrics, maybe your churn rate's higher than it needs to be, that type of thing, that's going to come out in the financial model, because they're going to look at your churn rate, or they're going to look at whatever the challenging metric is, your conversion rate, what have you, and they're going to realize that if that doesn't change, then it's going to be really hard to get to the outcome that you both want. So it's a good way for them to zoom in on the economics today as they are, and you're kind of tightening the screws on it, and you're saying, okay, now take these and extrapolate it out for 5 years, right? Keep this going for 5 years, and then what does this all culminate to? And if it's under the same set of metrics that you have today, is that a good outcome or a bad outcome? If it's a bad outcome, how much do they have to change by to get to a good outcome? And do I believe that this team can do that? And so it's just another way to just put some pressure on the investment opportunity and just understand a little bit better at a little bit more of a granular level the scalability and the economics of your business, as well as your own understanding of your business and how you're thinking about attacking the market. So those are the main things that investors want to see when it comes to your financial model. The last question that I want to go over is, what are some of the most common finance questions that investors will ask? In general, the biggest thing that investors really want to analyze, I think from a financial perspective, is the level of growth that you have today. So basically the traction, like assessing where things are today and how far you've come. So they want to see, how quick is this growing? Like, how trying to get an early sign on the market and an early sign of what's to come. And so that's present talk, so like present and past. And then, what is the future going to look like, and what does the future economic model of your business look like, and how scalable is it? Those are the two things that they're wanting to look at. So if we're looking at the past and the present, they're going to look at, what is your year-over-year growth been? What is your month-over-month growth been? They're going to want to look at, within your revenue formula, where are the most important metrics, where do they stand? I keep coming back to churn, but if you're a software business or a subscription business, churn is a big metric to focus on. So they want to understand, where are the key levers of your business? Like, where are they today? How do those affect the unit economics of your company? So let's say I have a high churn rate, but my unit economics are still really good because my price is very high, and maybe I've still got really great expansion revenue, right? So maybe they'll be able to stomach a high churn rate, customer churn rate, if your net revenue retention is really high and your margins are really high and things like that. But they're going to want to understand that. They're going to want to dig into your numbers to understand what the unit economics of your business are. And they're also going to want to understand, how much have you been growing? How quickly have you been growing? That's going to give them a sense of just the level of heat in your market, the level of heat in your business. And it's going to inform, the past typically informs the future, so it's going to give them a sense of what's going to keep happening with your business as well. It's going to be a lot of just kind of unit economics today. How quickly are you growing? Those are the types of things that they're going to want to dig into and understand. From a future perspective, it's what I talked about a little bit earlier. What do they want to know about your financial model? They're going to want to dig into the scalability of your customer acquisition, right? They're going to want to make sure that you can continue to get logos, and they're going to want to ensure that you can continue to drive customer acquisition through the channels that have been proven, and continue to dig into new customer acquisition channels. A lot of times, investors will want to ask about your ability to go upstream. If your prices today are one thing, but you're wanting to increase prices over time and go to bigger and bigger customers, they're going to want to dig into that. So they might ask you about strategies. In general, the theme of what, investors are going to ask is you to defend the numbers that are in your financial model and defend the narrative that's in your financial model. Those are the types of things they're going to want to dig into. Outside of that, it's going to be the common unit economic questions. It's going to be, what is your CAC, right? What is your lifetime value? Things like that. And just trying to get an understanding of kind of what the current state of the business is from a financial perspective. They're also, of course, going to want to understand how much leverage they have in the conversations. They may ask, what's your runway? Like, how much time do you have before you run out of cash? Those types of things. And of course, they're going to want to dig into past financings and understand how much people have raised in the past and what the valuations are and things like that. But those are typically the most typical finance questions that we've heard. That's it. Those are the big questions that I wanted to make sure that we covered, and hopefully this was helpful. We love to give a lot of content to the Techstars ecosystem. We love giving webinars about Financial Modeling 101, how to use a financial model to supercharge your business, and how to use a financial model to supercharge the fundraising process. It's a lot of what we talked about here in this series. So hopefully we'll get to chat with you all a little bit more and go a little bit deeper. If anybody has any questions and wants to reach out to a member of the Forecastr team, you can email me personally, logan@forecastr.co. Or if you want to learn a little bit about Forecastr and see how it can help your business, go to www.forecastr.co.co and fill out a demo request form, and a member of our team would be happy to meet with you. Thanks for giving me the opportunity to talk to you all about finance and financial modeling and fundraising, and hopefully it was helpful.